All right, everybody, welcome to week 19 of selling weekly lottos. Every week, I sell what's the equivalent of lottery tickets to gamblers by selling options in the stock market, and that's how I make passive income. Start with the disclaimers. Number one, all my positions are covered. Covered calls and cash secured puts only, and I don't use margin. The reason for that is because with margin, you can get liquidated. You can lose everything and possibly even owe money. I don't want to take that risk. Number two, I'm happy to sell the shares or buy the shares if I'm assigned. I'm selling out of the money calls and puts. So if I'm selling my shares, it's because the stock's ripped. If I'm buying the shares, it's because the stock's dipped. I'm cool with that. And then number three, you're gonna hate to hear this, but this is not free money, guys. People say it's free money. If you say it's free money to me, I'm gonna make this face at you. All right, it's not free money. There's a risk, and that's why we're getting paid the premium, because there's a risk, and we deserve pay for that risk. All right, that being said, this week's winner is me. All right, no one's won the lottery from me yet. 19 weeks in. All right, this week I made $1,571 using $238,000 in collateral. That's a 0.66% yield. Now you may be thinking, hey, you only made $1,500 using almost $250,000. Well, if you have an extra $250,000 around and you're able to do this every week, you're going to be making almost $80,000 in a year. All right. So let's take a look at my positions. All right. First one was a Netflix 1,260 call. Sold it for about $857, sorry. Bought it back for $90. That's a $767 profit. Second one, Meta, 730 call. Sold that for about $524. Bought it back for $65. And that is about a $450 gain. All right. And then the third one, AMD 215 puts. I sold two of them. Sold those for about $500. Bought them back for about $200. That's about a $350 gain right there. All right. So let's take a look at the charts and what happened in my head to make this happen. First thing we're going to look at is the calls. I'll move over a little bit so you can see. All right. Bazam! All right. So if you're new to this, I'll start with saying this is not technical analysis. I'm not predicting the future price of the stock based on the historical trends of the stock price. These lines and these drawings are all based on the options I sold and the parameters of the contract to help you visualize exactly what's going on. I actually don't even use these lines. I just drew them for you so it can help you understand. All right. So with Netflix, is closer one to me. Netflix was pumping. All right. And like I've been saying for the last couple of weeks, when the stocks are pumping, the options market is pricing in or factoring in the chance that it's just going to keep going. All right. So the prices of the calls are going to go up more than they usually are. All right. So I sold when it was around 12:30, the covered calls for 1260. Now this yellow line for both these charts is the trajectory that the price has to go in order for me to get assigned. That green line on top, that's what I call the gambler line or the max gain line. That's where I will get the max gain, and anything past that line, the gambler is going to get all the profits from then. I'm not going to get any more profits after that green line. All right. And then the white line is where I sold the price of the shares. I sold the contracts. All right. And then that red dotted line down there is new. That's what I call the trader's break even. So if you're a short-term trader and you're just doing this as you're going to close both positions regardless, you're going to sell your shares, you don't want it to go below that red dotted line because it's a net loss, the amount that your shares lost in value exceeds the amount of premium you got from the option. That doesn't matter to me because I'm an income investor, so I'm just hoping it doesn't crash like 20-30%. But yeah, so as you can see, Netflix was pumping, and then I sold the covered calls. I was a little bit early, a day early. I could have got a few hundred extra bucks, but as you can see, it crashed and then it dipped more, and the green circle is where I took my profits. And actually, the Netflix shares went below that red dotted line, so I technically got an account value loss this week, but doesn't matter to me. All right, and then with the Meta, the far away one, the price of Meta actually went above the white line, so I got a gain on my shares and I won the contract, so that's a double win. All right, let's take a look at the put, AMD puts. Okay, some wild stuff. Let's do a little zoom out first, show you what happened before I sold the puts. All right, Kamehameha. All right, so as you can see here, AMD went crazy on Monday last week. It went up 40%. All right, and when it went up 40%, I was obviously like, no, because I had the shares 2 months ago and I sold them. Always feels bad when your stock goes up after you sold them, especially when it goes up 40%. All right, so let's zoom in a little bit. All right, so here's what's going on in my head after it went up 40%. Okay, the first 2 days, Monday and Tuesday, my logical side of my brain is like holding back my emotional side of my brain from FOMOing in, okay? Fear of missing out. So I'm trying to stop myself from FOMO, all right? On Wednesday, it does this crazy move, goes from 210 to 240, pumps even more. Now my emotional side of my brain is beating up my logical side of my brain, saying we should have FOMO'd in, we could have had profits, all right? And by Thursday, I was finally zen. And I decided the most responsible FOMO I could do is by selling out of the money puts, way out of the money puts. So I sold the 215 puts for about $275 each. And then on Friday, the next day, it crashed. And those 215 puts that I sold for $275 each went to above 900. And I was just like, of course this would happen. After 4 days of fighting myself, it just the next day, all right? But a good thing is, if you notice this red line for the puts, that's the loss line, okay? That's where anything below that red line, I'll have to buy the shares at 212.25, no matter what. If it goes to 200, if it goes to 150, even if it goes to 0, I'll have to buy the shares for 212.25. So below that, I consider a loss. All right, but you'll notice that crash, that it ended up being just a dip, but at the moment it felt like a crash. It ended up just $1 above that break even line, right? Not break even, sorry, maximum loss line. All right, no, sorry, not maximum loss. Okay, just the loss line. All right, so I was actually pretty confident there, and I was right that was the lowest it's gonna go. So I was pretty confident there that I chose a good loss line, and it bounced up from there, and it eventually recovered back to the price that I sold the contract. So I exited that position, and I was the one that got lucky this time on that. It was a wild ride. All right, let's take a moment to talk about the Greeks, Delta and Theta. Actually, I can't believe I didn't talk to you about this in the last 19 weeks. All right, let's pull up the screenshots. Oh yeah! All right, so a lot going on here, and remember, I like to use Robinhood for my viewing all the stuff and then trade on Fidelity. All right, but don't focus in on all the stuff. Just let's look at the Delta and the Theta for today. So Delta is the amount the contract will go up and down if the stock price goes up or down $1. All right, and then Theta is the amount the contract will go down if the stock price doesn't move, it stays flat after 1 day. All right, now don't focus on the specific numbers. Let's look at the ratio. So as you can see from the AMD contract, the ratio, theta to delta ratio, is double. So it's double theta of the delta. And for the Netflix, it's almost 4x. There's 4 times the amount of theta that there is delta. And what that's showing me as a seller is that the price of the stock, of the shares, has to go up or down incredibly fast in order for the gambler or the buyer to win. And that benefits me. Time's on my side, basically, as the seller. So that's generally what I look for. I prefer when the theta is higher than the delta. All right. Now keep in mind, these change daily. They can even change by the minute based on the price of the shares, and they change every day. So this was the beginning when I first sold the contracts the first day, and by the day before the contract, these numbers are going to be completely different. All right. And also, just because the theta is higher than the delta doesn't mean it's a great contract to sell. It's not the only factor. And the opposite is true as well. Just because the delta is higher than the theta doesn't mean it's a horrible contract. All right. But like I said before, I do prefer the theta to exceed the delta. All right. Let's take a look at my benchmarks. All right. Bazam! So, as you can probably notice, I added this column. I was telling you last week how I had kind of a broken spreadsheet because I wasn't considering the unrealized gains or losses in my like benchmarks. So I added this, and I didn't realize it before, but there's a lot of complications. There's a lot of variables to consider when you think about unrealized returns. With just the Lottos, it's really easy. You just take the amount you made, divide it by the amount you risked, and you get the yield. All right, 3 variables. But with unrealized, there's all sorts of things going on. So for now, I'm just going to write either a loss, even, or gain until I can figure out how to quantify exactly how to calculate unrealized returns. All right, but let's zoom in on the results so far, okay? So far, 19 weeks, I made $27,000, all right? How many Subway sandwiches is that? Like 10 now, all right? And although I did make a higher income this week because I risked more, my yield is down. So that pushes down my average weekly yield, but it raises up my average weekly income, which I'm okay with. I actually kind of want more income now, and my yield is a little pumped up anyway. All right. That's projecting me to get to about $74,000 if I can continue this for a year. All right. And that's around a 56% estimated APY, annual percentage yield. And my total yield is still above 20.5%, and that is beating holding index funds. So I'm pretty happy with my returns, guys. I hope you learned something today. I hope my videos have been helping you understand selling options, selling covered calls, selling cash secured puts. And if you're interested in learning about this, or you're a beginner, feel free to make a comment, and I'll try to answer it the best I can. I'll try to LE5, explain it like I'm 5 for you. And as usual, thanks for watching. I'm really grateful that you're all tuning in every week, all the new subscribers I'm getting, all the new viewers, and I really appreciate that you're here, and that I can try my best to help. All right, that's it for me this week, guys. Peace.